All right, so thank you everybody for showing up to the another webinar with pack of educational information for all of you guys in real estate. Tonight we have with us Erica Baldino. Erica is the Exchange Director for Legal 1031 Exchange Services LLC and Vice President of the Business Development for Kensington Bongar National Land Service. She has been licensed a title producer and notary since 2013 and have closed thousands of residential and commercial title insurance transactions nationally, as well as she oversees many of the IRC's 1031 tax deferred exchange. So without any further ado, Erica, it's all yours.
Awesome. Hi, everybody. For those of you that just kind of came in the waiting room, I run my education moments very talk like a talk back. So if you need to stop or have questions, Douglas is watching the chat box. You can sort of just yell into the mic. I'll hear you, and we'll get any clarification that you guys need.
Yeah.
Um, so I just put this legal notice so you can't sue me. I'm not an accountant. I can't give you tax advice. I'm not a lawyer. I can't give you legal advice. Our role is to act as the middleman. And we always, as I'll go through the presentation, we always encourage when we are talking about a seller about the possibility of a 1031. We always encourage that those professionals are involved as well in the discussion. Um, so some of the keywords that I like to start with, or sort of key sentences that I like to start with. If you go on a listing presentation and the seller says they've owned the property for a very long time, the seller has not lived there 2 out of the last 5 years, there's rent being collected. So it could be a single family, but they've not lived there 2 of the last year. It could be a multifamily. Or the property was bought very, very cheap and is selling for much more without any construction. So if you hear any of those keywords, that's when you know to call me. That's when your client could have a huge gains issue, and by selling that property, you could cause a taxable event. So be on the lookout. The biggest thing you have to remember to ask the seller is, have you lived here 2 out of the last 5 years? Let's take a look at what that looks like. So how we help is we provide qualified intermediary services. We prepare all of the 1031 exchange documents. Those funds then go to an independent escrow account that is FDIC insured, which is very, very important because there are some QIs that do this that are not insured. And if some of you guys remember when Signature Bank failed a couple years ago and there was that sort of mini blip financial crisis, there was actually a lot of investors that lost all of their money because they were in exchanges that were not insured. That's not us. We're one of the biggest in the nations. We do everything correctly. So let's do a real life example of what gains look like. Because the other thing that clients will do to you is they'll incorrectly tell you, well, I bought the property for $200,000, but my mortgage is $600,000 and we're selling it for $1 million. So my gains are only from 600 to $1 million. The mortgage has nothing to do with what your gains are. The gains are where you bought the property, then they factor in any sort of construction costs. But then as you depreciate the property on your taxes, if you do standard depreciation or cost segregation, it brings your basis down. So that's where your basis is. And then what you guys sell it for eventually they'll be able to calculate the taxable event. So let's look at this example of a New York property. It was a multifamily property bought in 1996 for $1 million. And in 2016, there you are 10 years later, the real estate agent sold it for $4 million. Federal capital gains tax on that $3 million, so that delta is $714,000. Then the feds have what's called a depreciation recapture. That's another $190,000. And then the state of New York actually taxes another gains tax of $264,000. So that means this person bought for $1 million and they sold for $4 million, but come tax time next year, they have almost $1.2 million in taxes to pay. So at closing, it sounds like you guys did a really good job for them as the agent. They quick made a $3,000. But when they realize that there's a taxable event of $1.2 million, they may have not even gone with the sale if they knew that that was their taxable event. So how can we avoid this person from paying almost $1.2 thousand? The answer is in the world of real estate, there's a couple things you can do. There's what's called a deferred installment sale. That's what you guys know is the seller holds paper. The seller holds a mortgage. So they could have sold it for $4 million, but if the seller holds a mortgage, they're not getting all of those proceeds at one time. That's not what I do. They also could put their money into an opportunity zone. Also something that I don't do, but I know a lot about them. And you may have heard the words, the abbreviations OZ. It is a way that you can defer taxes. There's something called a charitable remainder trust, which we see in real estate, where the proceeds can go dedicated to a charity so that they don't pay any taxes. And then last but not least, there's where I come in. The seller could elect to do a 1031 exchange. They could put the $4 million in with me, and then you guys can go find them another property or properties, not just in New Jersey. They're able to exchange all over the United States. And for those of you that invest outside of the country and you are a New Jersey taxpayer, I'm actually able to do 1031 exchanges outside of the country as well. So if you have a property in the Dominican Republic and you want to sell it and buy a property in China, we can do that as long as you're not bringing the money back into the country. So kind of a good tidbit for those investing overseas. I could do a quick opportunity zone overview, although the federal government's been changing opportunity zones. But essentially, you can, instead of using me, you can have the proceeds go into a part of the state that they've decided is in a blighted area. And then you actually pay no gains at the ends of 7 years. So it is a good option for investors. But let's move on to actually what I do for a living. So the IRS states no gain or loss shall be recognized on the exchange of real property held for productive use in trade or business for an investment if real property is exchanged solely for the property of like kind which is to be held. This is a fancy way of saying they will not tax your client if you buy another property or you buy into a managed, like a REIT that's also managing other property. There's this distinction like kind. And a lot of people incorrectly think, well, I'm listing a two family, so I have to find my client another two family. That's not correct. You just need to find them a real estate investment. They could sell a multifamily house and then you could put them into a cold storage warehouse. It doesn't matter how they're making money on the property. It just has to be for investment purposes only. The reason, oddly enough, the history of this and why the IRS makes this distinction is because in the 80s, before the tax changes that happened, you actually could 1031 real estate into anything of value. So people were 1031ing into Ferraris, art pieces, Birkin bags, exotic fish. That was actually permissible under the tax code as it is now. The IRS realized people abuse that. You can't do that anymore. You have to sell an investment property and you have to buy an investment property.
Interesting.
Yeah. So this is sort of my wheel. You could pick any of these things. You even can have your client exchange into vacant land. Normally, it's vacant land with the intent to build or vacant land that is collecting a rent roll. So I did one where they were buying vacant land, but they were getting paid monthly for trucks to be stored there. And so that was permissible by the IRS because it was still for investment use only. So let's talk about what is not like kind. Okay, vacant, anything vacant. 1031 exchanges do not like vacant. You cannot list a strip mall that is vacant and sell it. It needs to be tenanted. Same thing with flippers. I get a lot of phone calls with flippers. I'm not good for flippers. The reason is they don't look at a flip as used for investment use only. Investment is having tenants, it's collecting tenant income. It is a different type of business per the IRS to flip real estate. And also, if any of you guys have flipped before, you know that once you start to factor in all of the construction costs that you put into a flip, you can kind of minimize your gains. It's not like, you know, an old lady coming here and buying in Brooklyn for $10,000 100 years ago, and now all of a sudden it's $4 million. So flips are not good for the 1031. Also, it cannot be held for personal use. You cannot 1031 exchange your primary residence. You can your beach house, you can your second home, provided that it is some sort of income. But if it's your primary residence, you only have the deduction that the IRS gives you, which some of you may know when you represent sellers, which is the $500,000 deduction if you're married. Um, Unsure how to reinvest funds. So, common replacement properties that we see larger investors go into are triple net leases. Some of my investors with an older portfolio are just tired of being in the multifamily space, right? So I just had a guy who listed a $2 million asset in Patterson, and he was done. He was just tired of fixing the toilets. He was tired of collecting rent. He was tired of being a landlord. So that agent partnered with somebody out west, and they were able to 1031 exchange him into a Walgreens triple net. So get creative. It may be the difference of you getting a listing or not, right? It may be the difference of you approaching somebody who's a bit older with a portfolio who's relying on that, who says, no, 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 I can't sell. This is my livelihood. All I do is manage property. To overcome that objection, it's wait, let me introduce you to Erica. Let's do a 1031. Let's do something easier that's not such a managed asset. And normally, if you let me talk to the client, I can kind of convince them as well. So how we can help. So one of the common mistakes that I get for first-time exchangers is people will actually call me after the closing is finished and they say, "Hey, I just sold my multifamily for $1 million. All my money's inside my bank account. Can I do a 1031 exchange?" You cannot. The money has to go to me prior to the client taking it. So the client can never take their money off the table. So how you get me involved is upfront. If you know that you're listing a property and at the listing presentation, you can call me. I have agents that'll call me during the listing presentation to explain a 1031 exchange to their client. As soon as that client is under contract, I get a copy of that contract and we open up the 1031 exchange escrow. There's paperwork that the buyers and sellers both have to sign. And then at closing, the buyer's title company wires it to my team. So your client cannot touch that money. Um, there's a
So,
difference between a complete tax deferral and a partial deferral. So let's say you get a client, we tell him, listen, you're selling your $1 million multifamily. Let's say there's a $500,000 mortgage on it. We need to buy you something that's $1 million or more that has at least a $500,000 mortgage on it. That's a complete deferral. If they say, no, 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 I don't want to find something for $1 million. I want two properties. Well, then you could find them two properties that are each, let's say, $500,000 each, and that's okay. But if they say, no, 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 I want to take some money off the table. I have some debt that I want to pay. I owe some people money, and they only replace $900,000, then they're going to get taxed on whatever the delta is. So if there's $100,000 difference, they're going to pay tax. Sometimes that's fine. Like sometimes, as long as you make the client aware, they're okay with $20,000, $30,000 in tax, as long as it's not $300,000 in taxes. So just be mindful that when you're looking for the replacement property.
okay, I want to stop you for a second, and I want to go back to the previous slide where you mentioned that you have real estate agents that during the presentation they are able to call you. So what I'm hearing you say is you're available in case the agent has questions as soon as that you identify that there's a possibility of a 1031 exchange that the owner may have. Uh, the objection is, well, if I sell, I'm going to pay a lot of tax into it. Then, that should be the trigger to say, listen, there's another way to
Correct.
do it, and we have a team. We have a partner that we work with, and that's when they can bring you into the deal to help them with that 1031 exchange.
Correct.
Correct?
So you don't have to be an expert on 1031 exchanges. Let me be the expert on 1031 exchanges. But if you hear any of those buzzwords that we talked about at the beginning, if you hear that you think they're going to be a candidate, text me right at the listing presentation and tell your prospective client, you know what, I'm just going to get a qualified intermediary right on the phone with you. Let me just get the expert on the phone. And then I can have a little bit of a conversation with that person to sort of just talk them off a ledge and prepare them for what's going on. That being said, I'm happy to take that phone call on the random Thursday that you're at a listing presentation, the random Saturday that you're there, because it could be the difference between them listing with you and every other agent. How many other agents know a QI? How many other agents can come in offering that information? Um, and so it really does help, I think, to have kind of me in your pocket. The other thing when it comes to kind of sort of how I go above and beyond is that, and we'll get to sort of making the offer on the purchase, but when you make the offer on the purchase, there's a lot of residential real estate agents that don't understand 1031s at all, and they may shy away from that offer. They may not want to take the offer because it's an unknown and it's a variable. But I get on the phone and I actually explain to them that a 1031 exchange is a better than cash offer. And I explain it to them because once that property is identified to purchase, your client can't back out. After 45 days, if they can't back out or they pay capital gains. And if their gains are $200,000, they're not leaving that property. So I'm happy to sort of enter in negotiations with the buyer's agent. And there's been many times that I've won the deal for our clients because they're talking to a QI when the offer is presented.
Great, excellent information.
Yep. Okay, so kind of let's go to the timelines that I kind of sort of started to say, but then skipped forward. So your client has 45 days to identify a property from the day you sell it. They have a total of, at the bottom here, 180 days to close. What that means in this market, we all know that 45 days is not a long time to find a house. This market is insane. So it is crucial that you identify that your client needs to do a 1031 exchange as soon as you go under contract so that they can be looking at property and doing their due diligence during the entire time that they're selling that property. That way, when they sell, they'll know within a week or two, hey, these are my 3 properties that I've identified, and this is what I intend to close on. I see many failed exchanges where the agent can't get them under contract or can't identify properties in 45 days. I've had personally an exchange. A friend of mine was trying to buy 200 units out in Louisiana, and after day 45, half of the asset burnt down. But because he had identified it in his 45 days, he actually still had to buy it. So he bought the burned down building, and I think he burnt it. I think he bought it because he could use the insurance money for it. But it was just a shame that it was after day 45. Um, and then the total 180 days to close, you don't need to use all 180 days to close, but that is the statute. The only time the timeline difference is if there's an act of God or some sort of federal emergency. So like if we ever have a hurricane, if we ever have flooding, it will change the 1031 exchange timeline. But you can't just call me at day 46 and say, Eric, I'm so sorry. Can I have an extension? It doesn't work like that. So like I said, it's very crucial to know if the client's going to do this to start searching for property. The identification must be in writing. You have to describe the property. So you have to tell us the fair market value. It's got to be signed in date and it's got to get to us by day 45. We hound both you, the agent, and your client. We'll hound you like through the entire 45 days if we have to, so that we get the identification paperwork on time. There are 3 rules when it comes to a 1031 exchange that you can pick. The first is the one that most first-time investors that do this use. It's called the 3 property rule. It's as easy as it sounds. You can identify up to 3 properties. There's also 2 other rules that people hardly use in residential real estate, and it's the 200% rule. So you can identify up to 200% of the properties, meaning if you're selling a client's property for $1 million, you can identify up to $200 million worth of properties. So if you've got a client that's looking to scale up, somebody that sold for $1 million but wants to buy a $20 million building, you could theoretically use that rule. And then there's the 95% rule, which people very rarely use. You have to close on 95% of the properties that you identify. That's super hard to do because, as you guys know, people break contracts and somebody might need to pivot during due diligence. So we don't ever really see that rule enacted. We normally just see the 3 property rule.
Okay.
Um, Common mistake that I see, identifying only one property in the 45-day rule. It's a great idea if you're already under contract and if you know you're buying it. It's an awful idea if you're not under contract and God forbid somebody else comes in with a higher offer and kicks your client out. So don't only find them one property. Um, there's also something called a Delaware statutory trust that you can identify. Basically, you could tell your client to put all of their funds into a REIT or some sort of managed asset, which I can go into if there's questions on it, but it is sort of high level, so I'll sort of skim by it now. Um, Points to consider. The client must replace mortgage debt. If there's a $500,000 mortgage on the property they are selling, they must put a $500,000 mortgage or more on the property that they're purchasing. A lot of people think, well, my profit was only, the mortgage. Nobody cares about what your profit is. It's all about the gains. So the mortgage has to be replaced. Um, and like I say in the second bullet point, you can always have your client do a cash out refi after they buy the property. Like they can always pull that out tax free if they've got a ton of equity. Um, Same taxpayer rule. What this means is the seller has to match the buyer. So if Mary and Joe are the sellers, then Mary and Joe have to be the buyers. Joe just can't buy the property without Mary. It doesn't work. Or if 123 Main Street LLC is the seller, then 123 Main Street LLC must be the buyer. So keep that in mind as you guys are filling out offers. Um, Again, long-term hold, not for flips. So this is not a product for flippers. And the one thing that we do say in the industry is swap till you drop, which is a really messed up way of saying once you start to 1031 exchange, you have to continue to do it. If you decide to stop, meaning you sell your investment property, we do a 1031 exchange together, and then you want to list that new property 100 years from now, you will be taxed at the basis of the first property you sold. So we tell people never to sell, just die, and then your next of kin inherit it at a step up in basis. And that's probably the most important thing that I talk about because this is how families preserve generational wealth. They don't actually sell their real estate assets. They hold and hold and hold, and then when they pass away, their next of kin get it without paying any taxes.
Hmm. So
Um, Douglas, did you
that
have a question?
yeah, that one that's interesting. So once you start doing the 1031s, you want to continue. You don't want to sell it. Like I sold the two-family house. I made a profit. I took that profit and I 1031 it into a building that was a six-family unit. Now I don't want to sell the six family. I don't need to sell the six family. I shouldn't sell the six family. I should continue
The
1031,
1031 exchange
maybe
again.
stepping up because
Correct.
if I die, which I will at some point, right? I
Correct.
leave it to my kids and they'll have a tax gain. So they're not going to be
Right.
taxed.
Right. So basically, they don't
Okay.
pay for the sins of their father, right? So let's say the two family that you bought, your first house, let's say it has a basis of zero. Let's say you've had it for 20 years, you did no construction to it, you've depreciated it every year on your tax return. I'm assuming most of you guys understand depreciation or at least writing stuff off. Like you depreciate, 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 and your depreciation is zero.
Yep.
Now you list it and it sells for $1 million. That means you have a gain of $1 million. And if you didn't 1031 exchange with me, you'd probably have to pay the IRS $300,000. You avoid that. We 1031 exchange into a building. Let's say 10 years after this building is now worth $5 million. You sell that. You buy another something for your portfolio, $10 million. Let's say you're at $10 million, you're happy as can be, and you say, you know what? I'm selling it. I want to retire. I'm done. When you sell it at $10 million, you will be taxed at your basis of the first two family asset, which was zero. So 0 to 10 million, your gains on that, you're going to have to pay the IRS $3 million, $4 million. Unless you die, your kids inherit it, and then the next day they can sell it for $10 million because they're inheriting it at $10 million because they inherit it at fair market value when you pass. The
Now,
only thing
when
that, go ahead.
sorry, because this is getting interested. I don't know about everybody else because they're very quiet, but I'm, uh, when you're doing this 1031s and I'm taking, obviously, a lot of these could be investments, right? A lot of times the investments are under an LLC. When you 1031 these properties, are in your LLC. Can the LLCs be on a trust?
Yeah, you could do trust too. We do trust. Yeah, it could be a trust. So either a trust could hold the LLC or it could just be a trust that has the property. It depends on how you can get financing because I know from trust deals, most lenders will only finance a trust purchase up to 50 LTV.
Okay.
But you could do the LLC and have a trust hold it. That's fine as well for estate planning purposes.
Okay.
So that's why we say swap till you drop.
Got it.
Common questions.
Yeah, one more question. One more question. Let's
Sure.
say you have two properties or three properties under an LLC, right? And you want to sell the three of them. Can you buy, let's say the three of them are 1.5 million, 500 each, right? Can you take those, if you sell them all at the same time, can you get that and exchange it? All of them, or you have to do them separate, each of them separate?
So it depends case by case. If you can try to get them to sell all within like a week to 2 weeks together, and they're all in the same LLC and they all can come to me, let's say it equals now $3 million. Yes. If you have $3 million in my exchange, you could go buy one building with that. That's fine. Or you could put $3 million down and buy a $10 million building. That's fine. If they're all held under different LLCs, then you have to pre-plan before you do this. Because if that's your goal, you may want to retitle them to all the same LLC so that they're cohesive. Or what's most confusing is that you can leave them in the different LLCs and then all three LLCs can buy one property. So it would be like green LLC and yellow LLC and blue LLC as tenants in common. So all three would take their $1 million and move forward.
Got it. That's what
We
you're talking
also,
about.
yeah, we also didn't get, and I don't even know if I talk about it. I don't. We also didn't talk about partners on LLCs. So let's say Doug and I buy a building. We've held a building for 20 years, and I say, Doug, I'm done with you. I don't want to invest with you again. I know we're in the same LLC. I know we're 50-50 partners, but I can't stand you, and I'm going to Florida. Well, what happens is
Well, if you're
either
moving to Florida, I wouldn't want to invest with you either.
So what happens is you have to know with your accountant prior to sale, because either Douglas and I have to break the LLC up into Douglas's LLC and Erica's LLC as tenants in common. And then I can take my million and go to Florida, and Doug can keep his million here. Or if you don't realize that till after you list and we're a day before closing, either me or Douglas, one of us has to buy out the other. So if the property is selling for $2 million, I'm going to have to give Douglas $1 million liquid so that on paper, it's called a drop and swap. I buy out Doug's interest and then I could take the $2 million and push forward with it. But it's very important with structures of LLCs because the common thing in New Jersey is for somebody to form one LLC and put 7 partners on it. And it's great when they hold the asset for tax purposes, but it may not be great when they hold the asset to sell it if 1031 exchanges is their plan. The other thing that could happen is if Doug owns his own property and I own my own property and we want to buy something together. So if he sells his property tomorrow for $1 million and I sell mine for $1 million, and he says to me, "Hey, Erica, I like this deal. Let's go into it together." We can combine our millions as long as the LLCs are separate on title. So it would have to say Doug's LLC and Erica's LLC as tenants in common. It's very nuanced and it's complicated, but again, that's why it's important that a real estate agent gets us engaged prior to even listing so that the deed can reflect the way that it needs to be in order to effectuate the sale without paying taxes.
Yeah.
Some of the questions that I threw up here. So what if I do not elect any replacement properties by day 45? So I like to stress to the clients, it costs $0 to open up an exchange with me. If at the end of 45 days the money is with me, you guys have tried your hardest to find a replacement and cannot, then we just charge them our relinquished exchange fee, which is about $1,500, and then we close the exchange. The problem is if you elect a property during your 45 days, and then like day 65, you're like, Erica, you know what? I don't feel like buying this house. Just screw it. Give me my money back. I have to wait 180 days to give you your money back. And some investors get mad at me because I'm making interest on their money for 180 days and they can't have access to pivot. But unfortunately, that's just the rule of the IRS. So again, 1031 exchanges can be very successful as long as there's pre-planning. Let's see. There's other exchanges that I will not bore you with unless you guys have a specific need for it. There's what's called a reverse exchange. I've done a couple of these last year alone, actually. And a reverse exchange is when you buy before you sell. So it's not so common in this market because everybody knows once they list, there's no problem listing, but it's buying that's the issue. But when the market is reversed, when there's not a lot of good, when there's not a lot of good um, properties out there to sell, but there's a ton of properties out there to buy, there are clients that will just quick scoop up a good property and then wait to have their assets sell if it sits on the market for 6 months. So that's called a reverse exchange, and we do handle those. Um, we also do construction exchanges, which are also complicated, and our fees for both of these things start at $7,500, much more than a normal exchange. And a construction exchange is if you're selling that property for $1 million, I told you you had to buy something that's $1 million or more, except if you buy something that's less and use the rest for construction. So you could buy something that's 750 and you could use 250 for construction of that property. The only caveat to
For
that is that,
for
go ahead.
improvements on the property you're talking about.
Correct.
So yeah, okay.
Correct. The only caveat to that is that that construction needs to be completed by 6 months, by 180 days. So not so difficult in the residential world, very difficult in the commercial world. And we have had people that are doing $200 million reverses and they're sort of cracking the whip at the improvements. But it can be done. Let's see.
Wow.
Yeah, so this is really it. So, the last thing that I like people to know is how you can refer me. So, obviously you guys are real estate agents, you guys are great referrals, but like CPAs, financial planners, commercial property owners, um, anybody that's really interested in not paying taxes is a good referral for me. I put in the bottom a case that I just had last year. I had a woman call me who was 83 years old. Um, she bought a shore house for $350,000 20 years ago, and she sold it for $2.5 million. She was sharp as a whip, and she decided to buy three multifamily properties up in North, each for $1 million. So this is a windfall for her real estate agent because her real estate agent helped her on the sale of the 2.5 million and then represented her on all three of her purchases for $1 million each. So she did like $6 million like this. And that's because she sort of identified the need for the 1031. She never told this woman that, or the women didn't know that a 1031 exchange was even out there. So she kept saying, I don't want to sell my shore house. I don't want to pay all this money. And now she's very happy because she's got three multifamily houses in Montclair and she's making money on her investment. So I am important for older people as well that's looking to downsize their portfolio.
Wow.
Um,
That's a lot of good information there. A lot of good
yeah, with
nuggets.
that, I know it's a ton, but with that, I'll take any questions. If anybody has any questions or scenarios,
Does
happy to
anybody
chit
have
chat.
any questions? I mean, there was a lot of good nuggets in there. So open your mic. Hmm, we have a chat group today.
It's okay. I
So
know it's a lot. Nobody loves taxes.
no, but that was that was pretty interesting. About the exchanges and being able to do it on on a trust. So
Yeah, I mean, at the end of the day, um, Some of the worst phone calls I get is when a client will call me and say, how come the real estate agent didn't tell me that I had to pay taxes when I sold my investment property? And I try to educate them. It's not really the real estate agent's job to understand tax law, but it is the real estate agent's job not to set the client up to fail. So just the simplest, hey, you know what? I sense that it's an investment property. I sense that there might be this issue. Why don't you call your accountant prior to selling? Why don't you call Erica prior to selling? Um, so that you don't sort of take any heat from this. Because at the end of the day, people trust the real estate agent implicitly with the biggest sale of their house, and they should be guided accordingly.
Yeah, they should, and I think that it is the duty and the responsibility of the agent to identify these potential liability, tax liability, with the clients and say, look, there's other ways. What do you want to
Right.
do?
Right. And you could say the exact line I say, which is, I'm not an accountant. I can't give you legal advice, but this is a trigger. I know that there's something here. I might not be able to spell it out for you, but like, let's call your accountant before we list just to make sure that come next tax time, you don't have to pull $100,000 out of the air. And then you're calling me going, I never would have listed the property with you if I knew that I had to pay all this money in taxes. It
Mhm.
just you could have had the best sale of your life. It could have been smooth. They could have loved you at the closing table, hugs, kisses. The minute that tax bill comes, you're enemy number one. And it's not even your fault, but that's unfortunately the way that it falls.
Erika,
Yeah.
I have a question.
Sure.
Let's say it's your personal, property home that you've been living there, but you moved out and you rent it and it's been now a year. Can they do 1031 exchange on something like that?
Yeah, but you're not going to want to because you can still claim your primary exemption. You could still claim that you lived there 2 out of the last 5 years. And that gives you this $500,000 exemption if you're married. And that's better than a 1031 exchange because you're not forced to buy something right away. See, the downside of the 1031 exchange is I'm making you stay in the market. I'm making you continue to buy high. If the market's inflated right now, you have 45 days to make a quick decision, 180 days to close. But if you can use that primary exemption, that $500,000 that you get, use it, take the money off the table.
Right.
So, don't skip straight to the 1031 exchange if you can say that you've lived there 2 out of the last 5 years.
But if it's more than 500,000, let's say it's like a $5 million
Right.
gain on that. It's possible to do something like that, or
Yes, yes. So if it's substantial and the $500,000 just a drop in the bucket and you're not going to get anywhere with that, yes, we could still do a 1031 exchange. You just have to make sure that it was rented for the year. You can exchange from a year forward, not more than that. It's got to be rented for at least 12 months.
Okay.
at least 12 months.
Yeah, it needs to show a year of rent roll.
Okay.
All right. Anybody else? I guess not. I guess everybody, you're very good at presenting, so everybody, understood and wrote notes and know what we're talking about. So,
It's a little bit
but
of information.
if
I'm
there's
pretty sure they'll call you if they need to to ask
yes,
questions.
and,
Oh,
and,
yeah.
and that was my next thing. That the number there in the email. I do have, I don't know if with Erica has your permission to, we have the recording, but we also have the slide. I don't know if it's okay to. Sometimes they want the slide, so is it okay
Yeah,
to give it to them?
the slides are fine.
Okay.
My cell is below. I pick up 7 days a week. If I don't pick up, text me who you are, and then I will call you back immediately. But it's the 609 number. So if I don't have you saved already, just text me and let me know who you are.
Excellent. All right. Well, if nobody has any questions,
And I have a question. If I sell my house 500,000 and I want to buy another one for 1 million, I gotta put the whole 500,000 to get a 1031 exchange.
Yeah, so if you sell your house for 500,000, no mortgage, right?
Yes.
So if there's no mortgage, yes, the entire $500,000 in order for a full taxable deferral has to go toward that $1 million purchase. So you'd take out a $500,000 mortgage and you'd put your $500,000 equity. After you're done with me, if you want to access that cash, you can put a HELOC on there or you can refinance to a 75 LTV or 85 LTV and you could take money out of the property. But for the purposes of the exchange, they have to follow the money. So that entire $500,000 has to go to that property.
Oh, okay. But in the opposite way, if that goes with the mortgage, I got
Yeah, opposite. Yep. So if there's a mortgage, let's say you're selling for 500,000, but there's a mortgage for 400,000, then you need to put a mortgage on the $1 million house for at least 400,000 or more. And then you've got to put the $100,000 into the house. And with those numbers, you will, because you're going to put, 250,000 down and you're going to put a $750,000 mortgage on it. So like you'll be there already.
okay. Thank you.
Mm-hmm.
Okay, I have a question. I had a scenario where I had a person who inherited a property, but then she converted it because she owned it for about 3 years, and she converted it into her own name. And then when she sells it, at that point, it would be capital gains. Would then that be beneficial to do a 1031 exchange in that situation, or do they still benefit because it was a inherited property?
So the first question is you have to talk to the accountant. We have to figure out what the date of death was, who she inherited from, and what the fair market value was at that date. So that's where you would come in with comps. So 3 years ago, they died on January 1st. That's the day she inherited it. What was the property worth? If the property's not grown so much in the next 3 years, like if it's kind of pretty even, then they may be able to just do the sale without doing a 1031 because the gains are minimal. But if appreciated substantially in the 3 years that she's owned it, has she been living there or she's been renting
No,
it?
it was a 6 unit. It was rented.
So she would need to do a 1031 exchange. But every time you deal with an inheritance, the question is, like we sort of talked in Doug's example, when the next of kin inherit, they get the step up in basis, which is a fancy way of saying they get the property for fair market value. So if it was $1 million when mom and dad died, 3 years ago, if it's only $1,000,001 now, sell it. Don't 1031 exchange, take your money off the table. You did really well. Go pay your taxes on the $100,000 delta. But if she inherited at $1 million and you're listing it for 3 million, well, now we have a problem. And we have to have a conversation on how to stop some of that taxable event.
Okay, thank you.
All right. Anybody else? Any other questions? Popping with this conversation. Clive, do you have a question?
No,
Oh.
I think I got it. Yeah, I think I'm good.
Okay.
Clive's sitting in the dark. What's going on over there, Clive? Are you okay?
No, the reason I'm sitting in the dark is because I'm by my mom and I'm trying to get her to relax before. That's why I kept the
Aw,
light. Yeah,
you're a good son. Hi, Mom.
yeah, that's why.
All right. So if we don't have any more questions, I would like to thank Erica for her time, for the information that she provided us, and all of you have her information, her cell phone still on the screen, email as well. I strongly recommend that you guys take a screenshot of that. If you need it, just text me, text Zoila, we'll send it to you. And we're also going to send you the recording, and we'll give you the recording. And if anybody needs the information, just give us a call and we'll provide it to you. Erica, thank you very much. It's always a pleasure, and look forward to doing some more business soon.
Yeah, thank you guys. And definitely reach out to me if you've got anybody that could be a candidate. I'm happy to chit chat.
Absolutely. We'll keep it in mind.
What?
All right, bye guys.
All right.
Thank you. Bye.
Bye-bye.
Thank you, bye.